Hey guys, Jake here. Today I'm going to talk to you about the financial markets, and more specifically, what are the financial markets? It's something a term I throw around in my daily life, but it's one that most people don't really know a whole lot about. So here I just wanted to simplify it, break it down, and try to make it as understandable as possible. So there are four main tradable, investable marketplaces. They are the stock market, the options market, the futures market, and the Forex market. Now there is also the bond market, and you can trade the bond market. I have friends who trade the bond market, but most people that I know get their exposure or invest in the bond market through one of the other markets. So say like a bond ETF or mutual fund, that's actually through the stock market, you're investing in bonds. Or through the futures market, you also can invest in bonds. So that's how I mainly invest in that investment vehicle. But bonds, the bond market is a tradable marketplace, and there's about $700 billion transact every single day. You know, I think the coolest thing about the financial markets is that there are so many people trading it. There are so many participants in the financial market that it offers a great amount of liquidity. And all that means is, like, say if you own a stock, if you own a bond, anything in the financial markets for that matter, you can get in and out, or you can own, or you can buy, you can sell, you can do anything you want very quickly. So with the click of a button, I can buy or sell a stock. With the click of a button, I can buy or sell a future. With a click of a button, I can buy or sell a bond. That's the coolest part about the financial markets, and I think one of the big draws to it. You can do anything you want to within a matter of a second on a computer. Whereas, say if you're investing in one of the other marketplaces, some like the real estate market, sometimes it can take months to sell a property. I've seen there's a house down the street from mine that's been on the market for over a year. So you don't have the ease of entry and exit that you get in the financial markets, which is one of the big draws. But back to the financial markets, the bond market. So, okay, let's back this up. Let's talk about Wall Street real quick. There are a bunch of people who hate Wall Street, they don't like Wall Street, and they don't really even know what Wall Street is. Wall Street is just an intermediary. They're just the person in the middle. They're somebody who connects two groups of people to make things happen. Those groups of people happen to be companies and organizations looking for money, and individuals who have money looking to make a return. So say if you're a company, let's just pick a company, let's say Apple. Everybody knows about Apple. If you're Apple and you want money, there are a few ways to go about doing that. You can go to the bank, you can get out a loan, the most traditional way about getting money. You can also come to Wall Street though. You can come to Wall Street, and when you come to Wall Street, you have two options. You can A, choose to sell little bits and portions of your company in the form of stock, or B, sell debt instruments, also known as bonds, out into the marketplace, guaranteeing people interest on the money you borrow from them. So Wall Street's just this middle person, but there happen to be a lot of people on Wall Street who make a great deal of profit making, or kind of widening out the middle. Like they make the middle, like they are the middleman, but they make the middle very wide and profitable. So they do that. I give them credit. They aren't stupid people, for sure. But they really just offer a service. They connect these two groups of people. So you have the bond market. Bond market is about $700 billion transact daily. You have the stock market, which only has about $200 billion transact daily. And the stock market also includes things like ETFs, exchange traded funds, which are just the better version of a mutual fund. A mutual fund is just a ETF wrapped in a fancy package, so they can charge you fees. Again, them widening out the middle part, being very sneaky. But anyways, you have the stock market, you own little shares. So you got stock, bond market. I mainly trade this. You mainly see people trading the stock market. However, you can trade the bond market. The other marketplaces, we have the Forex market. The Forex market short for the foreign exchange market, is where you trade currency. So if you've ever been on vacation, say if you're going to Europe, you're in the US, you need to change US dollars into euros. And there's always an exchange rate, right? Like $1 equals 70 euros or 70 cents, 70, whatever the heck it is in euros. But you know what I'm trying to say. There's that exchange rate. It's not 1 to 1, it's 1 to something. So the banks invest and they actually move a lot of money around in the Forex market. Because think about it. Banks are in the business of money, right? They have people bring money to the bank in the form of deposits, and then they go out and invest that money in the form of loans and other things. And currency fluctuations, so say if suddenly one currency is way more valuable than another, greatly affects their business, which is currency. So they move a lot of money around in the Forex market, and therefore it's actually one of the biggest marketplaces. You see over $4.4 trillion moving around every single day in the Forex market. It's very big. And those are the big ones if you don't want to be in the space of derivatives. Now, derivatives are where it gets fun, and derivatives are where I mainly trade and invest. But derivatives, what a derivative is really just a contract to buy or sell something, and that something is the underlying asset. So say if it's like a stock or if it's gold, you're making an agreement to do something with something else. So it derives its price from that something else. So a derivative just derives its price from something else, an underlying asset. And the world of derivatives is massive. It's quite massive. And just to give you guys an idea about how big it really is, I found this cool little thing. I saw this on social media once, and I thought it would be perfect for our discussion here. So let's just start off here. So you see this little square. It says each square this size represents $100 billion. So this will just be a visual representation of the world's money and markets. So this is just a picture version of the values. So we start off here with the smallest square, which is Bitcoin. I love Bitcoin. I recently started investing in Bitcoin, but you can see there's only about $5 billion as of the writing of this, which was the end of December, worth of Bitcoin in the world. Here's a visual representation of Warren Buffett's current, or as of that time, net worth. Here's Bill Gates' net worth. Here is the largest company in the world, Apple's market capitalization or net worth, so to speak. Keep coming down. Here is the total amount of above ground gold valued if we're using $1,200 an ounce. All the gold in the world above ground. Here is all stock markets. You can see all stock markets. I'm just trying to get it all in the picture here. All stock markets. And you can see that the US has the largest stock market in the world, taking up 52% of this area. So we come down here, all global debt in the world. You know, a big discussion nowadays is how much in debt the US is. You can see we're only about 29% of the total debt in the world. And it's quite a big amount. And then the last box I'm about to show you here, and what really this is all meant to show you, is the world of derivatives. The low-end estimate of how much money in the scope and size of the world of derivatives is about 630 trillion. So if you're looking at this, remember here's the US debt, here's all debt in the world. Here is the space of derivatives. Now where the blue turns to black is the change from the blue is the low end estimate and the black is the high end estimate. And you can see there's quite a differential between the two. That's because a lot of derivatives products, you can see the high end is 1.2 quadrillion. The problem with the space of derivatives, and the reason why nobody really knows how big they truly are, and just again here's Bitcoin, and then that was derivatives, is because a lot of derivatives products are traded over the counter, which just means that they're private agreements between two individuals. So it's just between, like, say, me and somebody else. Two individuals, two parties, it's a private agreement. And there's no way to track the true value of all of those things, so they just make rough estimations. There are exchange-traded derivatives, which are the products that I'm talking to you about today, that the retail investor like me and you have access to without having to be accredited or somebody who knows other people on Wall Street. So the two marketplaces that we have access to in the space of derivatives is the options market and the futures market. So let's start with the options market. The options market was invented as a form of insurance to insure the value of the stocks you own, right? Just like you have a house, right? So somebody has a house and they want to protect the value of their house, right? What happens if it goes up in flames, right? They get homeowners insurance to make sure that they don't lose all the value if something bad were to happen to the house. In that same way, you can use an option to insure the value of your stock. Okay? And just like how a lot of companies make a lot of money by selling insurance, right? So any company that sells insurance, I think it's the perfect business model. Because think about this real quick. They sell you something that you might never use. Ever. I've never used my car insurance. My parents have never used their homeowner's insurance. You know, it's one of these things that you have to have, but that you may never ever use. But you pay for every month, and they collect that money. So just like how you pay for insurance, and they're making money every single month for something that may never happen, you can do the exact same thing, except you can be the insurance company in the world of options if you sell options. And that's actually my main trading activity, is I sell a lot of options because I love the business model of insurance. Somebody who's selling insurance is making money. So I sell options, which are a form of insurance. But just like how you can sell insurance, you can also buy insurance. So say I do own a few stocks or equity positions in my retirement accounts. And I say if there's a big earnings event coming up, or say if I was worried about the market going into a full-fledged bear market, just like we had in 2000, 2008, I could go out and buy insurance against my stocks to make sure I don't lose all the value that's there. So that's the options market. The last market we're going to talk about is the futures market. So the futures market is also a derivative because it's deriving its price from something else. Okay? And the futures were invented a while back, and they were created originally to solve this problem that farmers had bringing crop to the marketplace. So say if you were a farmer and you grew corn, for example, right? So you grew corn, and at the end of the harvest season, you harvest all your corn. You spent months and months and months growing this corn, right? It's not a short process. You got to plant it, you got to water it, you got to wait, you got to hope there's no bad weather, you got to hope there's no drought, and then finally you get to pull all of your crop and go to the marketplace and sell it. But what happened if you were the last person to the marketplace, right? And just to keep this example simple, say you're a cereal company, right? So say you're a cereal company and that's the only person who's buying corn, right? So farmer 1 goes to the marketplace and sells the cereal company all his corn. Farmer 2 goes to the marketplace and brings all of his corn and sells it to the cereal company. Farmer 3, who's the last person to the marketplace, doesn't get paid. Why? Because the cereal company bought all the corn it could buy. It can't handle any more corn. It couldn't make any more cereal if it wanted to. So farmer 3 was shit out of luck. He never got paid. And as a farmer, you can't continue going on like that. You spent a great deal of the year growing this crop that now you can't get paid on. That is not a viable way to live. So that was a huge problem for them. So what they started doing is creating contracts. So they originally, and just like how a lot of the over-counter derivatives I was talking about are just a private agreement between two individuals, futures contracts are an agreement between two individuals, and it would be originally from the farmer, how much corn he was going to bring to the cereal company, and for the cereal company to say how much it was going to pay the farmer when he brought the crop. So number one, the farmer knew how much he was getting paid when he brought the crop and knew he was getting paid. Number two, the cereal company knew how much crop was coming its way. They could plan accordingly. So anyways, over the years, these contracts started to become a tradable instrument, and we can trade them now today. And there are three main types of futures. You got the commodity-based futures, which are things like corn futures, soybean futures, lean hog futures, wheat. You have gold, you got silver, you have oil. You have indexed futures, which are things that follow the value of stock markets. So you have like the US stock market futures. You have things that are currency futures that follow the value of different types of currencies. But the big draw that derivatives bring to the table is their amount of leverage. So you put a little money in, you can make a lot of money, or rather control a lot of money, right? So the big draw that future or any type of derivative has is the amount of leverage you have. It's also a big draw of the Forex market. The Forex market has about 50 to 1 leverage in the US. So you're controlling about 50 times more than whatever you put in. So you put $1 in, you're controlling about 50. So in futures, to give you an idea of how large of an instrument it is, one futures contract, let's just pick the S&P E-mini future, which just follows the value of the S&P 500, the best, I guess, representation of the US stock market. One contract requires you to put up about $5,000, but it's controlling about $100,000 of notional value. So there's a large amount of leverage in that vehicle, and something you have to be aware of and be careful of if you don't know what you're doing. Because just like how leverage can amplify returns, it can also amplify losses if you don't know what you're doing. Futures products are very cool. They also have options on futures, which is a derivative on a derivative, that's extreme leverage. I don't even play in that space. I don't think I'll be ready for that for a few years, but just telling you it exists. And the big difference between options and futures is options is the writer. So say you sell or buy an option contract. It's the right to buy or sell that underlying stock at a set price by a set date, but that doesn't mean you have to, right? Like the stock, that might not mean that, just like insurance, you don't always use the insurance. You might not ever use the contract, right? But in the futures contracts, it's an agreement, just like how the farmer was bringing the corn to the cereal company. If you hold a future all the way to when it expires, that corn or that gold is coming to your house. Now, there are a lot of things people think that you can get in trouble that way. Now, your broker will try to stop it from happening. And I think you have to set up a special account to actually take delivery of the commodity. Like if you're trading a crude oil future, 1,000 barrels of oil is not just going to randomly show up at your house. But just know that the difference is that there is actually something being delivered at the end of the day. I think that's the biggest difference between the two. And I love the world of options. It gives you about 10 to 1 leverage. You can make similar returns as that of the stock market using about 1/10 the amount of capital. And that's the main draw for me. But yeah, just thought I'd throw this out there for you guys who don't know too much about what the financial markets are. Again, you got the stock market, options market, futures market, and Forex market. And sometimes if you want to, you could trade the bond market. That's it. I hope you guys enjoyed, and I'll talk to you guys later.